Michael bought Apple stock at $150 per share in January 2022. He read about the company. He believed in the technology. He believed in the future. He held through the summer decline. He held through the fall. By December, Apple was trading at $130. He was down $20 per share. On 1,000 shares, that was $20,000. He sold in January 2023. He needed the money. His car broke down. His emergency fund was depleted. He took the loss. 6 months later, Apple was trading at $180 per share. If he had held, he would have made $30,000. Instead, he lost $20,000 by selling at the bottom. Michael is not an idiot. He is not reckless. He simply did what most people do when they participate in the stock market. He failed. Here is what makes this worth understanding. Stock market failure is not random. It is not luck. It is not about picking the wrong stocks. Failure is systematic. It follows predictable patterns, and understanding those patterns is the only way to avoid becoming another Michael. Most people who fail in the stock market fail for the exact same reasons. They make the same mistakes. They fall into the same traps. They get caught by the same psychological mechanisms that have been catching people for decades. Let us start with the first failure pattern, buying at the peak. The stock market operates in cycles. Prices rise, sentiment builds, media attention increases, new buyers arrive. Prices rise further. Eventually, prices reach a peak. At the peak, sentiment is highest, media attention is at maximum, new buyers are arriving in greatest numbers. This is when most retail investors buy, not at the beginning of the cycle, at the end. They see the stock has already gone up significantly. They feel like they are late. They do not want to miss out further. They buy at exactly the moment when prices are least likely to go higher, when they are most likely to decline. This is the first failure pattern, peak buying. It happens to the majority of retail investors. They arrive after the move has already happened. They buy what is already expensive. They hope for more gains. They get declines instead. The second failure pattern is holding through losses, waiting for recovery. Michael is a perfect example. He bought at $150. The stock went to $130. He told himself it was temporary. He told himself Apple was a good company. He told himself long-term investors hold through volatility. He was right about all of that, except holding through losses requires two things most people do not have. First, you need capital reserves. If you need your emergency fund for emergencies, you cannot afford to hold through losses. You will be forced to sell at the bottom when you need the money. Second, you need the right time horizon. If you buy at the peak, you might need to hold for years or decades to recover. Most people cannot wait that long. Life happens, jobs end, emergencies occur. They get forced to sell. Michael had neither. He did not have reserves. He did not have the time. When his car broke, he had to sell. He sold at the worst possible time. The worst possible time is usually when you need the money most. The third failure pattern is performance chasing. You see a stock that has already gone up 300%. You see a fund that outperformed the market for 3 years. You see a sector that is booming. You chase it. You buy in. You assume past performance predicts future results. It usually does not. The stock that went up 300% might be overvalued. The fund that outperformed for 3 years might have been lucky. The booming sector might be in a bubble. Performance chasing is the retail investor way of buying at the peak. It is mechanically identical. You wait for something to prove itself through past performance, then you buy it. You buy it after the move has already happened. You buy it when the probability of continued gains is lowest. Chasing performance is betting on continued momentum. Momentum is real, but momentum reverses, and when it reverses, everyone who chased the performance gets caught holding the peak. The fourth failure pattern is not taking profits. Imagine you bought a stock at $50. It went to $100. You doubled your money. Most retail investors do not sell. They hold. They think it might go to $150. They think they might be leaving money on the table. Sometimes it does go to $150. More often, it goes back to $80, and the investor who was up 100% is now only up 60%. If it drops further, they're back to break even. If it drops further still, they're in a loss, and now they're holding a loss in a stock they could have sold at 100% gain. Professionals take profits regularly. They have rules. When a stock doubles, sell half. When it triples, sell more. They lock in gains. Retail investors do not. They hold hoping for more. They often get less. They end up watching profits turn into losses. They end up selling at the bottom instead of the top. The fifth failure pattern is overconcentration. Michael bought 1,000 shares of Apple with his available capital, all his eggs in one basket. If Apple had continued up after 150, he would have made enormous profits. But Apple went down, and he had no diversification, no other holdings to cushion the blow. Just Apple, all in. Overconcentration magnifies both gains and losses. Most retail investors do not understand this. They think diversification is boring. They think concentrated bets are how you get rich. They are right about one thing. Concentrated bets can get you rich. They can also get you broke. The math is asymmetrical. If you have a 50% loss, you need a 100% gain to recover. If you have a 70% loss, you need a 230% gain. The deeper the hole, the harder it is to climb out. Overconcentration creates deep holes very quickly, and most people do not have the capital or time to dig out. The sixth failure pattern is poor market timing. Market timing is the belief that you can predict when prices will go up and down. Retail investors are terrible at market timing. They sell when prices are low because they panic. They buy when prices are high because they are greedy or afraid of missing out. Their timing is inverted. This is not a skill problem. It is a psychological problem. When prices are falling, fear is high. Panic selling is the natural human response. When prices are rising, greed is high. Panic buying is the natural human response. You cannot overcome this through skill. You can only overcome this by having a system that removes emotions from decisions. Most retail investors do not have systems. They have feelings, and their feelings make them buy high and sell low, consistently, repeatedly. Michael's timing was terrible because he did not have a system. He sold when he needed cash, which was at the worst time. He could not time the market. No one can. But having a system is not the same as timing the market. A system removes the emotion that makes timing terrible. The seventh failure pattern is not understanding what you are buying. Most retail investors cannot explain why they own what they own. They bought because they heard about it, because a YouTuber mentioned it, because it was trending, because a friend made money on it. They did not do fundamental analysis. They did not understand the business. They did not have a thesis about why the company was undervalued or had potential. This creates a fragile conviction. When the stock declines, they question whether they made a mistake. When news hits that is slightly negative, they panic. They sell because they do not actually understand what they own. They cannot distinguish between temporary noise and genuine problems. If you understand what you own, temporary decline feels like opportunity. You can handle volatility because you have conviction. Most retail investors have no conviction. They have hope, and hope is not enough when prices fall. Now, here is the synthesis. These failure patterns are not independent. They interact. They compound. You chase performance and buy at the peak. You do not take profits when you are up. Your position becomes overconcentrated. You do not understand what you own, so you panic when it declines. You sell at the bottom because you need cash and have no reserves. You have poor timing because you have no system. You hold through losses because you tell yourself long-term investing works, but you had to sell anyway because emergencies happen. Each failure pattern makes the next one more likely. Peak buying makes overconcentration more painful. Overconcentration makes you more likely to panic sell. Panic selling at the bottom means you need to hold for years to recover, years you do not have. Here is what is really happening underneath all of this. Most retail investors are participating in the stock market for the wrong reasons. They are participating because they feel like they have to. They are participating because they need the returns to fund retirement. They are participating because they see no other options for wealth building. This creates a dangerous psychological state. You are forced to participate in a market you do not understand. You are dependent on returns you cannot control. You are playing a game where the stakes are your financial security. This is the environment where all these failure patterns flourish. Because you are desperate, you chase performance. Because you are dependent, you cannot afford to take losses. Because you are ignorant, you panic when prices fall. Because you need the money, you sell at the worst possible time. The uncomfortable truth is that most retail investors are destined to fail, not because they are stupid, but because they are playing a game where the odds are against them. The game requires capital reserves they do not have. It requires time horizons they cannot afford. It requires emotional discipline they have not developed. It requires knowledge they were never taught. Michael failed because he was playing the game under exactly these conditions. He needed that money. He did not have reserves. He did not have time. He did not have discipline. He did not have knowledge. The question worth asking is not how to fix Michael's mistakes. The question is whether fixing the mistakes changes the fundamental reality that most people are not equipped to win in the stock market. Because even if Michael had sold half his position at $100, even if he had diversified, even if he had held with conviction, he still would have needed emergency cash at some point. And when emergencies happen, discipline does not matter, systems do not matter, you sell, and timing is everything in the stock market.